What's up, everybody? Welcome back to Wealth Not Wait. I am your host, Joseph Coizza, and I just want to share this little story with you guys. So I thought about a while back how when I first started getting into investing and sort of my financial planning, I had a conversation with one of my very close friends. We were on a trip, and we just sort of started talking about things. And it was around the time where I had started to get into my finance and managing my finances. And I've only been doing it a couple months, but in those few months, I had learned at that point a lot of useful information. So I was talking to somebody who really hadn't watched as many videos and wasn't as in tune and in depth with all that information as I was. And they said that they have all their money in a savings account, which was a mistake that many of you would see that I'm very vocal about, that I made early in my life. You know, anytime I got money, I would break it up and then put some of it in a savings account and spend the rest or allocate it however I would. But I would put part of it in a savings account thinking that I was saving and I was doing good. And while saving your money in an account isn't inherently bad for certain reasons, if you're trying to build wealth and grow, especially as you enter your adult years, I was just in middle school and then high school at the time. But as you enter your college and adult years and progress further in your life, investing all that money is extremely important and not just having it in a savings account. So I talked to him about it and he said, well, I want to make sure I have enough money in case of an incident or an emergency. I have enough money to cover what I would feel be a nice sized emergency, which is absolutely amazing. That's what you should do. You should have at least $1,000 emergency funds. And when you start to grow and get everything off the ground, you should then translate that into about 3 months to 6 months worth of wages. In the event you lose your job or a major emergency, if somebody gets sick or some unforeseeable event happens, that's, you can't plan really for the unforeseen, but you could have some form of cushion in place that can hopefully help dampen that when that issue comes about. So he said he has probably what we equate to about 6 months worth of his money. That wasn't the exact number he gave, but doing the math and the estimate on it, I would say it's probably about 6 months of the money he would make at a time. Minimum wage job, high school, that was probably about the time it would be 6 months worth of his income, which is great. But then he's saying that's all he's putting his money into. He has more than 6 months worth of income that he's just putting into savings. He's keeping it in cash. Now, those of you who are even somewhat savvy, even somewhat listen to any investor, a lot of people tell you cash is the worst investment to have. If you're, spending money or doing something, obviously cash is great. But if you're trying to make money or maintain your wealth, cash is horrible because naturally it loses value. There's this thing called inflation, which I'm sure many of you know, but many of you also may be learning. Ooh, inflation, what's that? Is that like a balloon? No, it's not a balloon. It's what happens to your money. And essentially what it is you lose value on your money each year. Now, that's a big step. Some of you are like, huh? What? I lose value on my money? Yes, you're losing value in your money. That's why things back in, say, like the 20s cost, a nickel or 5 cents, and now today they cost $10. Along with other factors that are extremely important, inflation is one of those big factors. The cost of living goes up as, supply decreases and demand gets higher. Inflation naturally occurs, and normally it's about 1 to 2%. It could be higher as 3%. It could be 10%. If something really bad happens, or it could be less than a percentage. It averages out. But on average, it's probably about 2 to 3%. If you really want to plan for it, that's probably a good number to use. So just having his money in that savings account, he had it for probably about, let's say 3 or 4 years. He had that money. He lost, let's say, 2% at minimum over those 4 years. That's 8% of his money if you combine the percentage, but it would compound. It's the money that he has. So say he had $1,000 and then he lost 2%. He's not losing another 2% on the money he had before, but he's losing 2% on the money he had then. So naturally, he'd just be losing value with his money. And while it's good to have an emergency savings, like I said, he'd be putting all of his money into that. That's not good. Any of you who would find any financial information online, they tell you, yes, you should have emergency savings, yes, you should have some sort of backing for your money, but you should also invest your money as soon as possible. And their whole thing was, well, it's safer, I could get access to it, I'm not really big in investing, I really don't. It's okay. Take your time, watch videos. That's what channels like myself and other, reputable channels and books and information and courses are out there to do, is to educate people, because a lot of people don't know about financial education, don't know why investing is important. Now, if you don't know why investing is important, there's plenty of books you go out there and read, but a good sort of like introduction that shows you a scope is I would watch my other video on investing, and it kind of shows you how much money you could make, say, making minimum wage, versus if you would save just 10%. It's almost 11%, but it's within the 10% range of your income and invested it with average returns, how much you would get. Now go and watch that video if you haven't already, and then you'll kind of see, wow, yeah, it's very important for me to save because I can't retire, I can't grow wealth just purely off of what I'm making. Now, when I heard this, I tried to explain to him, hey, listen, it's very important for you to invest your money and you want to have any of it. He said, I would want to look at it, I would want to examine it every day. And one of the things I learned in The Intelligent Investor by Benjamin Graham, it's actually the person who taught Warren Buffett all, the basics of investing and what kind of got him set on his successful ways. It was Benjamin Graham, and he wrote a book called The Intelligent Investor. And those of you who know me and who know the channel and reading any of my material, I love The Intelligent Investor. It's the thing that sort of kicked jump started me on revamping my financial situation. I was always interested in finances as such a young kid. I started a business when I was 13, and I was printing out comic books at the age of 8 and selling them at my dad's work. But this what really got me started on investing, really got me started to look into financial education, because it was such an important issue that a lot of people were uneducated with. About 80% of Americans live paycheck to paycheck. That's horrible. 80% of Americans don't know if they're going to be able to eat next week if they lose their job, if they don't get that paycheck, which is absolutely atrocious. So I got interested and I tried to educate them, and you can't really teach somebody who doesn't want that information. And it's not that they were stubborn or anything, they just felt more comfortable doing what they were doing naturally. And they said, well, if I had any form of money into something, I want to analyze it every day. Now being a financial savvy person, or hopefully learning finances, if this is your introduction to how often you should check your finances, the answer is almost never. You should never be looking at your finances on a constant daily basis. Like, I have all my stocks and information, I have it, online, and you can go through stuff, and you have paper, and you have all this information that tells you it, and I'll check it to make sure to see how it's doing, but I never let that make my decision. Knowing this person, and they blatantly told me, seeing how it would do on a daily basis would freak them out and go, I need to make decisions on it. You act emotionally, you act irrationally. That's what you're not supposed to do. You're supposed to be very cold and calculated when you make your investments. If you know this is a good investment, it's going to fluctuate up and down, with the market. If you're investing in something like stocks or really any investment is going to fluctuate up and down with the market, because the stock market especially is very much a voting game. While it is backed by how well a business is doing and how it's transacting, it's very much on what people are willing to pay for it. The business could be making billions of dollars a year, but if nobody wants to pay for the stock, then it's not going to have a high value stock. If it's making negative money, if you're losing money, it's hemorrhaging money and flooding more water in the Titanic after it hit an iceberg, but people want to pay for it, stupidly as people do, and as big investors do, they'll throw money into it and the stock price is super inflated. It's the job of the investor, if you're picking individual stocks or even in the market, is to value, is this a good investment for my money? What am I going to make? And then you invest it. If it's a good option. If not, find something else. You don't have to, as Warren Buffett says, you don't have to swing on everything. A pitcher only gets so many, or a batter, sorry, I'm not big on sports, my brother would hate me for that. But you can only swing so many times, you can only get, so many hits on a ball when it's thrown to you in a game of baseball. And then plus, of course, people are going to be screaming at you, as Warren Buffett says, he goes, but you don't have to have any of that in investing. All you have to do is make one good investment. You don't have to invest in everything that comes your way. You can look at it and go, nah, it's not for me. And you can pass on a million things. You can pass on as much as you want until you find the right thing. Because when you find the right thing and you put the right money into it, it's going to be profitable. Now, when I was speaking to me, he said he wanted to have all that money available. He wanted to look at it. He wanted to have it for an emergency. Like I said, emergency funds are very good, but he would want to, view that money every day. He wanted to know how to have a play-by-play of it, what to do, and he would act irrationally on that. That's what you should not be doing. If you're looking at the day's worth of your stocks and they're going up and down and up and down, and you're going, oh my God, it's going down, I gotta stop. Calm down. Take a deep breath. Go get something to drink. Go have a water. Go relax. Count to 10. Do something. Just don't act irrationally. Money doesn't act irrationally. Money is logistical. You put money into something, it works by the numbers. Money doesn't go, well, I feel like making you, this much money today, or I feel like losing value today. Money doesn't do that. And as Mr. Wonderful will say, don't cry over money, because money will never cry over you. It's a fact. Money will do what money will do. It'll follow the numbers and it'll go the way it goes. It won't act irrationally or emotionally. We as humans, we act irrationally or emotionally if we're not in the right mindset. In an investor mindset, they won't act irrationally or emotionally based on day-to-day valuations, unless it's something big, like, the company, decided to go to business today. That's maybe something you should look at. But something like, the stock price fell, or the earnings weren't exactly what people wanted. I just had that happen with some of my evaluations. The stock prices weren't what we wanted, so the stock price dropped about 10%. Well, jump now to a week later, the stock price is almost back to where it was. People who, the stock's going to do horrible, I better sell. it's not going to do well. And understandably, I made the mistakes early on in life. I would keep something for a little while and go, oh, this isn't doing good, let me sell it. Well, then I would lose money. If I would have kept it to the point where it was doing good, and I would have picked the right stock. Now, I didn't know if I was picking the right stock back then. I'm more confident in that now. I read The Intelligent Investor. I looked into it now. If I pick a stock, it's something I'm going to hold for the long haul. But back then, it was just like, oh, I know that name, let me buy into it. And that did very well for me, and that also did not do so well for me. Some of the not so well ones, I look at, oh, it's doing horrible, let me sell it. That was stupid on my part. But there was something smart I did, and I was a little lucky. I'll give it more luck than brain power on this one. Was something's doing really well, let me not sell. Something's doing really well, I believe in this company. And a lot of those I actually hold today because there's some of my better investments. I got lucky on them. Some of those better investments did well, and I didn't sell them. But this person would have acted rationally, kept a large amount of money in cash only in a savings account. That's horrible. That's stupid, and that's how people don't build wealth, is they sock money away beyond what they need. It's good to have an emergency fund, don't get me wrong. I keep one myself, and I advise people to keep emergency funds, but they work past that issue. They go, okay, I have, almost a year's worth of supply of money, which, if you're planning for something or you have that set up as a precaution, but he was doing it unintentionally. He goes, yeah, this is just my life savings. I put it in a savings account. Well, how much is that savings account worth? I know mine was earning a percentage of a percentage. That's 0.01%. Not 1%, but written as a decimal. No, it was 0.01%. Again, a percentage of a percentage. And it wasn't earning any money. When I heard that, and I asked the gentleman when I was redoing my savings account, he goes, oh, no, it's going to earn the same interest rate. I was like, well, how am I ever going to build wealth? That's something I realized. That's something, unfortunately, his friend hadn't realized. And I tried to explain to them. They go, no, well, emotionally, I'm better off setting it up like this. And that's something I want to talk about, is you can't let emotion get in the way of your investments. Now, it's good to have gut feelings and understand. If you don't understand something, don't invest in it. That's obviously a given. And you have to think sometimes with emotion in that regard. But, I'm confident in something. I work the numbers. Here's how it's going to be. And then you see maybe some of the results within a day or a couple weeks or even a month, maybe a year or so. And you go, oh, I'm going to act irrationally. Oh, I feel it's not doing well. Let me sell off and lose money. If you were confident in it and you check the numbers and this is how it should work, this is how it's going to go, here's how the setup, or you invest in the market. That's why I advise people who don't want to pick their own stocks or go through the effort and the hassle of it, to invest in the market. S&P, Dow Jones, pick an ETF or pick an index fund or something reasonable, something reputable. Pick something that is going to adjust with the American economy. Now, some people, the American economy. You have faith in the American economy. It's one of the biggest economies in the world, and it's been here, probably almost definitely longer than most of you have been around, unless you're, a couple hundred years old. Unless you're a couple hundred years old when the stock market came out. The stock market's going to be here probably long after we are. I hope my great grandchildren are investing in the stock market and have the wealth that I built them, and that it continues to build. The American stock market and having a capitalistic economy is something that really works for America. A lot of people will maybe disagree on that, based on emotion, but it really works, and it's good at wealth building. So investing and not having a passionate and irrational mind when it comes to your investments is of the utmost importance. Not keeping all your money in a savings account, having something set aside for an emergency fund. You have that there, you have your emergency fund, but investing the rest. Don't be like this person where they had all their money socked away and they were more than prepared for an emergency, but they weren't building their wealth. And then when they get to the point where they go, oh, I should have been investing, they lost countless years. They could lose, it's been at least a year, I would imagine. So they lost a year worth of investing. Say now it takes another year or another 2 years for them to realize that. Well, maybe when they're in their 30s, we were young, we were, late teens when we were talking about this. Maybe in their early 30s when they start a family, they'll realize they lost 10, 15 years worth of investment. They could have been retired earlier. That could have been money upon money that they would make. That makes all the difference in investment. That's, 15 years. That's half of people's average life cycle for investment. You start at 35 because people get a late boom on it until they realize it's important, and they work till 65. That's why investing is so important, and that's why not being so irrational with your investments or being emotional about it and looking at what's best for you and planning is such important. You have to look at things logistically, and you have to look at things from the correct lens. You have to look at it and go, this is what's going to make me money. I'm prepared for an emergency, or maybe an IRA. Of course, your money will fluctuate and it'll change, but you're able to take out some of the money or all the money that you've put into it. Like a Roth or IRA, I know that's one on some of them and works for certain situations. You can take out all the money you put into it. And it's tax-free, essentially almost like a savings account with fluctuations. Obviously it's going to differ depending on what you invest in. It's different for everybody's situation, but you're able to save money for emergencies and then invest, and you may even be able to protect some of that investment in case you need to dive into that for an emergency, which you don't want to do. You want to keep your investments regardless of what happens and keep them forever. You know, you have a $10,000 bill you have to do to fix your car. You want to take that from an emergency fund. You want to take that in your investments, but you're able to arrange your investments and your savings equally. You're able to set that up, and you're able to have both, an emergency fund, God forbid car breaks down, or you need an air conditioner, or you fix your house or something, and you lose your job. You could have that emergency fund, and then the rest you can invest. The rest you can invest. The rest you can invest and build your wealth over time. You can do both, and it's important not to be irrational or be all emotional and worried about your money in that regard. If you know what you're doing, you take the time, or you seek financial advisors, and you trust them, and they know what they're doing, and they take the time. You have to put that money forward, and you can't be so frugal with it. Because in the end of the day, you're not building any money, and at the end of the day, you're actually losing money when accounted for inflation. And that's not going to get you anywhere. So that's going to be the end of the video, guys. Be sure to like and subscribe, and check out any more about our wealth building. This was a particular wealth video, but check out more about wealth and weight video as the channel would suggest. And be sure to check us out and stay posted. Thank you, guys.